Welcome. Today we're getting an update on Marco Polo Marine, a Singapore-listed marine company in the middle of not one, but two significant value unlock transactions. The company has been through a dramatic transformation over the past few years. In the next 10 minutes, we'll walk through what these deals are, why they matter, and what to watch for. This is for information only, not investment advice. Let's get into it. Marco Polo Marine runs three businesses. First, ship chartering. They own a fleet of AHTS offshore support vessels serving oil and gas operators across the Gulf of Thailand, Malaysia, and Indonesia. They also recently added a CSOV and three crew transfer vessels for offshore wind work. Second, their shipyard, 34 hectares, 4 dry docks, and a $298 million order book. Third, their offshore wind operations through PKR Offshore, or PKRO, operating in Taiwan, Japan, and Korea. An important structural point, MPM owns the CSOV and three CTVs directly and charters them to PKRO. That charter income already flows through MPM's own ship chartering segment. Shareholders are already benefiting from the offshore wind business in the reported numbers. What is not visible is PKRO's own operating margins and standalone P&L. Buried in a combined JV line shared with a separate Malaysian marine JV called Pelayaran Era. Here is the core problem. MPM has two types of hidden value. Problem one is the shipyard. When MPM orders a vessel from its own yard and pays its own shipyard, accounting rules say you cannot pay yourself. That revenue gets cancelled out. Right now, the CSOV Plus is under construction for PKRO, and a third CSOV is already in the planning phase. The construction of own vessels generates shipyard work that is invisible at the MPM group level. Problem 2 is PKRO. The charter income from the vessels is already in MPM's numbers. What is hidden is PKRO's own operating layer, its margins as operator, and its standalone financial position. MPM records only a combined profit share line shared with Pelayaran Era. The Taiwan IPO forces those standalone numbers into the open for the first time. So here is how the first deal works. MPM is injecting its Batam shipyard into Fuji Offset Plates Manufacturing, a catalyst-listed shell company, which will be renamed MPSE Limited, standing for Marco Polo Shipyard Engineering. The total consideration is up to 139 million Singapore dollars, paid entirely in Fuji Offset shares. No cash changes hands. MPM will own 74% of the new entity. There is an earnout of up to $19 million more if the shipyard hits 27 million Singapore dollars in cumulative profit over fiscal year 2026 and fiscal year 2027, 10 million Singapore dollars in 2026 and 17 million Singapore dollars in 2027. Completion is expected late 2026 or early 2027, pending EGM approvals at both companies. What makes this deal particularly compelling is that every party involved loses if it fails. Marco Polo Marine loses because the intercompany problem gets worse every year as they build more vessels internally. The family who control Fuji Offset and also hold a significant MPM stake through Apricot Capital would see Fuji Offset revert to a dying printing shell and lose on MPM too. And Lim Ah Cheng, who invested 4.5 million Singapore dollars in Fuji Offset, would see that investment collapse and lose his next platform after Dynamac. The alignment of incentives across all parties is strong. Let's talk about Lim Ah Cheng, known as AC Lim in marine circles. His track record speaks for itself. He joined Dynamac Holdings in 2020 when it was a struggling shipyard. He turned it around, delivered a 216% share price return, and sold it to Korea's Hanwha Ocean. Before that, he was at Keppel Offshore and Marine. Now, what we know publicly, he left Dynamac in December 2024 and immediately completed a chairperson accelerator program. He then bought 4.5 million Singapore dollars of Fuji Offset shares. The day after the RTO was announced, Darren of Apricot Capital and family owning Fuji Offset posted on LinkedIn showing him visiting MPM's shipyard with CEO Sean Lee and AC Lim. And at the results briefing, Sean Lee confirmed on record, AC Lim is part of Fuji Offset. His involvement will be more on fabrication. He has the leads, the contacts. His formal role at MPSE has not been officially announced. Watch for the circular. PKR Offshore is MPM's offshore wind subsidiary, 46.5% effective interest through Oceanic Crown JV. It operates the CSOV and 3 CTVs across Taiwan, Japan, and Korea under confirmed long-term contracts, including a 118 million Singapore dollar 15-year Taiwan Marine Port Bureau charter. A second CSOV is under construction for 2028 and a third in the planning stage. Taiwan IPO filing expected Q3 2026. Two things on the right worth noting. PKRO's standalone financials are not publicly disclosed, buried in a combined JV line. The IPO forces them into the open for the first time. No analyst has modeled a standalone value, no disclosed basis to do so. On strategic role, PKRO gives MPM local presence in Taiwan, Japan, and Korea. That access has already produced real results. The Vestas Charter, the Siemens Gamesa framework, and the Marine Port Bureau contract all came through PKRO's local standing. The vessel ownership structure creates a natural interdependency. MPM owns the vessels, PKRO operates them. If PKRO grows its fleet, the vessels need to be built somewhere, and MPM's shipyard is the natural candidate. If those orders come through, MPSE reports them as real external revenue for the first time. A separately listed PKRO with its own capital base in Taiwan could also fund fleet expansion independently, without drawing on MPM's balance sheet. That is the longer-term possibility the structure creates. None of this is guaranteed. It depends on PKRO winning contracts, the IPO attracting investors, and future vessel orders. But the alignment of interests across MPM, MPSE, and PKRO is by design, not coincidence. The financial picture supports the story. Revenue for the first half of financial year 2026 was 74 million Singapore dollars, up 40% year on year. The chart on this slide shows the longer-term trajectory. The difficult period from 2015 to 2019 when the company nearly went under, followed by a steady recovery, and now a meaningful step up driven by the offshore wind pivot. The business is profitable and generating cash. The two value unlock transactions are catalysts on top of an already improving core business. 3 of the 4 analyst reports rate MPM a buy or at with a target price of between 21 and 24 cents. FPA Financial has a hold with 14.5 cents, using a more conservative peer comparison methodology. All 3 buy-rated analysts have raised their PE multiples to reflect the deals, but none has explicitly quantified the PKRO stake value in their target prices. The reason is straightforward. PKRO's standalone financials are not disclosed, making it very difficult to model. UOB said it plainly. The key upside not yet in our numbers are the MPSE RTO and PKRO listing. Whether and when that gap gets priced in depends on execution. One more dimension worth noting. In January and March 2026, before the RTO was announced, Michael Kum purchased over 210 million MPM shares at 13 cents per share. He has over 30 years of marine offshore experience, previously invested in MMA Offshore, which was sold for 1.1 billion Australian dollars. He is currently non-executive chairman of Atlantic Navigation. In March 2026, an institutional placement was done at 14.5 cents. FPA notes, this price is more indicative of fair market value than Kum's purchase price. Then in June 2026, after the RTO announcement, CEO Sean Lee bought some shares at 14 cents. Darren Teo added to his stake, and Ginkgo AGT Global Growth Fund became a substantial shareholder. The current share price of about 14 cents is at the same level where these investors have been buying. So to bring it all together, 3 things to keep in mind. First, the MPSE RTO, a 139 million Singapore dollar deal that addresses a structural problem that worsens every year as more vessels are built internally. EGMs expected late 2026. Second, the PKRO Taiwan IPO, filing expected Q3 2026. PKRO's standalone financials are currently not disclosed. The Taiwan IPO forces price discovery for the first time. Whether that crystallizes meaningful value depends on what those financials show. Third, what remains in MPM after both listings? A direct fleet of 9 AHTS vessels, the CSOV Plus, delivering in 2028, and 2 new AHTS vessels deploying in 2027, plus 74% of MPSE and approximately 49% of PKRO. MPM becomes a marine holding company with two independently listed subsidiaries. What to watch? The definitive agreement being signed, the EGMs, the Circular Disclosing Board appointments, and the PKRO Taiwan IPO filing. Finally, the standard disclaimer. This video is for educational and informational purposes only. Nothing here is investment advice or a recommendation to buy or sell any security. Do your own research and seek independent advice before making any investment decision.